I'm joined by Paul Pittman, CEO of Farmland Partners. So, Paul, I want to know, first of all, how are things going with the planned merger with American Farmland? And also, what are the most immediate benefits you're anticipating from the deal?
So the merger will probably close in the first couple weeks of January. We're working our way through the SEC process, and that seems to be going well. Seems highly probable that it will close, and the shareholders from both companies are quite supportive. The immediate benefits to our shareholders are the diversification that comes from adding all of those specialty crop properties and giving us what's now the biggest ag platform in the United States, held by any REIT. We'll have $850 million of total assets and 133,000 acres across 17 or 18 states. So diversity is number one. And the second thing is the transaction is incredibly accretive. It'll be about 10% accretive to AFFO per share in the first year and 20% accretive in the year after that.
How would you describe the state of U.S. agricultural markets right now? And tell us exactly, how does Farmland Partners kind of fit into that picture?
Complicated thing when people think about farmland is they tend to confuse it in their mind with farming. And the farm economy is having a somewhat challenging time. It's not really that bad, but it's also not that good. Commodity prices are down, but yields, meaning crop yields, are way up. So farmer profitability and farmer incomes are down somewhat, but it's not by any means a disaster like we had back in the 1980s. So our role is fundamentally as a capital provider, right? So you're in an environment where it's an industry still dominated by family-sized businesses, and those family farmers are a little nervous and a little bit careful and husbanding their capital quite tightly. And so we become a potential buyer of farmland, a potential lender to these farmers, and we provide liquidity in a system where others won't right now. So it's really a good opportunity for us. We haven't seen significant distress. There's really not an opportunity to buy properties at deep discounts. I don't actually think that opportunity will ever come, and the reason is that this entire market's driven by that ever-increasing global food demand in the face of land scarcity, and nothing about the long-term outlook for food demand has changed. We've just had a couple of really big corn crops, which has led to price declines for the commodity.
And how does managing farmland assets or a farmland company, how does that compare, you think, to maybe the other real estate sectors?
The bottom line is, without built real estate, we look at our permanent crops like trees. That is like having a building, right? It has a defined life. It needs to be maintained. It'll eventually have to be replanted. You would have similar things. I mean, in a building, you got to re-roof it. You're going to have to reposition it. You might eventually have to tear it down and build it again. But that's only about 20% of our portfolio. The other 80% is just raw land. It's like a ground lease. I mean, there's not a lot of supervision and oversight required, and which lets us run our company very efficiently. I mean, we have about 15 employees and, as I said, $850 million in assets, and we could probably increase the size of the portfolio 40 or 50% without adding any additional staff. So it's a very efficient model, and I think that's the biggest difference between our company and other REITs.
Well, thank you so much for your time, Paul.
And thank you.
And for more information on this and other real estate news and analysis, be sure to visit REIT.com.